Technical analysis in Forex trading. Technical analysis is the study of historical price data. We analyze price movements over time, focusing on patterns and trends, and primarily using charts as our main tool. The goal here is to forecast future price movements based on past behaviors. Since Forex markets are incredibly fast-paced and dynamic, by analyzing past price data, we gain insights into potential trends and market behaviors. This allows traders to make data-driven decisions instead of relying on intuition alone. There are a few core concepts that a trader might need to understand. Firstly, price movements. Forex prices move in patterns or trends that are visible over time, like upward, downward, or sideways trends. Secondly, market cycles. Markets also tend to move in cycles, meaning similar price behaviors often recur due to trader psychology and external events. And finally, volume and time. We also look at volume and timeframes. Higher trading volumes generally strengthen a trend, while timeframes allow traders to analyze trends across different periods, whether that's minutes or months. Let's look at the different types of Forex charts that traders use. First, we have the line chart, which is the simplest type, showing only the closing prices. This is ideal for seeing the overall trend. Next, we have bar charts, which provide more details like opening, closing, high, and low prices for each time period. This is helpful if you need more data on each trading session. Finally, the candlestick chart is the most popular, with color-coded bars that make it easy to see trends and potential reversals. We'll mainly use candlestick charts throughout this courses, as they're widely used in Forex for technical analysis. One of the first steps in technical analysis is to identify the trend. There are three primary trend types. An uptrend shows higher highs and higher lows, indicating rising prices. A downtrend shows lower highs and lower lows, which indicates a fall in prices. Finally, a sideways trend or range-bound trend occurs when the price moves within a set range, without a clear direction. Now, let's talk about support and resistance levels. These are critical levels on a chart where price movements tend to stall or reverse. Support is a level where the price has historically struggled to go lower, while resistance is where it has trouble going higher. Traders use these levels to set entry and exit points, as prices often bounce off support or resistance, creating profitable opportunities. Now, let's dive into some essential technical indicators that help traders make sense of price movements. Moving averages, MA. This indicator smooths out price data, helping traders identify the overall trend. Relative Strength Index, RSI. RSI measures whether a currency is overbought or oversold, signaling potential reversal points. MACD, Moving Average Convergence Divergence. This is a momentum indicator that signals potential trend changes. And Bollinger Bands. These bands track price volatility and can signal potential overbought or oversold conditions. Each indicator provides valuable information, and many traders use a combination to confirm potential trading signals. Beside that, candlestick patterns are powerful tools in technical analysis. For example, single candlesticks, like hammer and shooting star, indicate potential reversals, while multi-candle patterns, like bullish engulfing and evening star, suggest trend continuation or reversal. To perform technical analysis effectively, you'll need reliable charting tools. Popular platforms include MetaTrader, TradingView, and NinjaTrader. Each offers a variety of indicators and customization options. If you're new to technical analysis, practice using demo accounts to familiarize yourself with the tools and indicators. This allows you to build confidence and develop strategies without risking real capital. That's all about an overview of technical analysis in Forex trading. Thank you for watching. Stay awesome and keep tuning in. See you in the next video.